$20,000. For most people, that number feels like oxygen. It's the first time your bank account stops scaring you. The first time an emergency doesn't instantly mean debt. The first time you look at your balance and think, maybe I'm doing something right. And that's exactly when most people make their first serious mistake. Because $20,000 is not just money, it's a decision point. Blow it, and you go back to zero. Park it, and inflation quietly eats it. Use it correctly, and it becomes the foundation of the next 200,000. So what should you actually do once you hit that number? Not what TikTok says, not what your uncle says, not what worked in 2021. What works now? Let's start with something uncomfortable. $20,000 feels big. It isn't. In most developed economies, 6 months of living expenses can easily be $12,000 to $18,000. One medical event, one job loss, one broken transmission, and a rent increase in the same month, and suddenly your investment capital becomes survival cash. So before you invest a single dollar, you ask one question: is this money free? Free means it can disappear without collapsing your life. If your monthly expenses are $3,000, you need at least 3 to 6 months untouched. That's $9,000 to $18,000 in pure liquidity, not invested, not locked, not it usually goes up. Cash. This is the part people hate. Cash feels lazy, boring, unambitious. But here's the irony. The wealthy obsess over liquidity. They don't chase returns first. They protect optionality first. Because the real power of money isn't growth, it's control. So step one, once you hit $20,000, is brutal honesty. How much of this is truly deployable? If the answer is $5,000, then you don't have $20,000 to invest. You have $5,000. Now assume you've handled that. Emergency funds secured. No high-interest debt lurking in the shadows. Here's the second uncomfortable truth. If you're carrying credit card debt at 22% interest, investing is a fantasy. Because 22% guaranteed loss beats 8% hoped-for gain every time. Paying off high-interest debt is not defensive. It's an instant risk-free return equal to the interest rate. People chase the stock market for 10%. They ignore the guaranteed 18% sitting on their credit card statement. It's financial theater.
So the order matters. Liquidity. Kill high-interest debt, then invest. Now let's talk about what investing actually means at $20,000. Because this is where fantasy enters. YouTube will show you screenshots. Crypto traders will show you Lambos. Real estate influencers will show you leverage. But $20,000 is not enough to get rich quick. It is enough to build a system. And systems are boring. Until they're not. Let's zoom out. Historically, broad equity markets have returned around 7 to 10% annually over long periods. Not every year, sometimes minus 30%, sometimes plus 25%. But over decades, that range holds. So if you invested $20,000 and earned an average 8% annually compounded, in 20 years that becomes roughly $93,000. Not life-changing overnight. But stack that with monthly contributions and the math changes dramatically. Add $500 per month at 8% for 20 years. Now you're approaching $315,000. Same starting $20,000, different behavior. The hidden mechanism isn't picking better stocks, it's time plus consistency. Here's the part nobody markets. Compounding is slow at first, painfully slow. Year 1, you earn maybe $1,600. Year 2, a bit more. It feels insignificant. But around year 12 to 15, the curve bends. Your money starts earning more than you're contributing. That's the quiet moment where the system overtakes effort. And that only happens if you survive volatility. Which brings us to the next mistake people make once they have $20,000. They overestimate their risk tolerance. Everyone thinks they can handle a market crash until their $20,000 becomes $14,000 in 3 months. Suddenly, long-term becomes very short-term. This is why diversification is not optional. Owning broad market index funds spreads your exposure across hundreds or thousands of companies. You're not betting on one CEO, you're betting on productivity itself. It's less exciting, it's also statistically more resilient. Now let's address the hype category: crypto, single stocks, options, real estate flips. Can you turn $20,000 into $200,000 quickly?
Yes. You can also turn it into $2,000. The issue isn't possibility, it's probability. When your entire investable capital is $20,000, concentration risk is lethal. A 50% loss requires a 100% gain just to break even. That math is cruel, and math doesn't care about confidence. So here's a practical structure. After emergency fund and debt cleanup, allocate the majority into diversified low-cost index funds. Keep costs low. Expense ratios matter more than you think. Over 30 years, a 1% fee difference can erode tens of thousands of dollars. Then, if you crave higher risk, carve out a small percentage, maybe 5 or 10%. This is your aggressive sandbox: crypto, individual stocks, experimental bets. If it works, great. If it fails, you survive. Survival is underrated. Now let's talk about something almost nobody mentions: taxes. Once you start investing, taxes become a silent partner. Capital gains, dividends, short-term versus long-term treatment. If you're constantly trading, you're not just fighting volatility, you're fighting tax inefficiency. Long holding periods tend to be more tax efficient. Retirement accounts, where available, add another layer of advantage. The wealthy don't just chase returns, they engineer tax efficiency. Same market, different outcome. Now here's where the story shifts. Because $20,000 is not just financial capital, it's leverage capital. You could invest it in markets, or you could invest it in yourself. Skills that increase income often outperform markets in early years. If a certification, business, or technical skill increases your annual income by $10,000, that's a 50% return in year one. Hard to beat. The question becomes, are you capital constrained or skill constrained? If your income ceiling is low, deploying some of that $20,000 toward income expansion can change the trajectory entirely. But this is where ego creeps in. People prefer passive growth because it feels sophisticated. Active self-investment feels uncertain. Yet statistically, your primary wealth engine in your 20s, 30s, even early 40s is not your portfolio, it's your earning power. So maybe the smartest move isn't 100% market allocation, maybe 70% market, 30% skill or business. Now let's address inflation. Holding $20,000 in cash long-term guarantees loss of purchasing power. Even 3% inflation cuts value nearly in half over 25 years. Cash is for stability. Assets are for growth. Mixing those roles creates confusion. Then there's the lifestyle trap. Once people hit $20,000, they upgrade. Better apartment, better car, more subscriptions. Not dramatically, just slightly. And slowly, savings rate drops. The most powerful variable in early wealth building isn't return, it's savings rate. If you invest 10% of income, your growth path looks one way. If you invest 30%, it looks completely different. At $20,000 saved, You've proven discipline. The real question is, can you maintain it once comfort appears? Because comfort is expensive. Now let's zoom out further. Why does this topic matter right now? Because we're in a world of higher volatility, higher rates, shifting economic cycles. Easy money environments distort behavior. People start believing risk is harmless. Then cycles turn. Liquidity dries. Asset prices correct. Speculation collapses first. If your $20,000 is positioned intelligently, volatility becomes opportunity instead of panic. Cash reserves let you buy during downturns. Diversification prevents catastrophic loss. Low fees protect compounding. But if it's over-leveraged or concentrated, volatility becomes existential. There's also something psychological happening. The first $20,000 feels monumental. The next $20,000 is easier. Not because markets changed, because identity changed. You're no longer trying to save, you're someone who saves. That identity shift is subtle, but powerful. And here's the quiet absurdity. Most people obsess over where to put the $20,000. Very few obsess over how to build the next $20,000, which is usually built faster. So, what do you do once you have $20,000 saved? You protect the base, you eliminate guaranteed losses, you build a low-cost, diversified core, you allocate a small portion to asymmetric upside, you invest in income expansion, you control lifestyle inflation, you optimize for tax efficiency, you respect volatility. None of this is flashy, none of it will trend, but over 10, 20, 30 years, this structure quietly separates people who always feel almost wealthy from those who eventually are. And here's the final uncomfortable thought. If you can't handle $20,000 calmly, you won't handle $200,000 differently. Money doesn't fix behavior, it magnifies it. So the real question isn't where should this $20,000 go, it's what kind of financial operator am I becoming? Because the habits you lock in at $20,000 will decide what happens at $200,000. And by the time you realize which path you chose, the compounding will already be in motion.